All right. So this is the Candlestick Trading Bible. And last week we did part 1. So I'm just going to do a quick review. All right. Let's go right here. We did the introduction, how the candlestick came to be. We had an overview of what we're going to be learning. We're going to be learning the candlestick's anatomy. We're going to be learning candlestick patterns, the market structure, time frames and top-down analysis, trading strategies and tactics, and money management. So this was the history. All right. So we learned right here that when it is a green candle, it's going to open from down here where the white body is at. That's the opening. So whenever you see a green candle, it's going to open from down here and close up there. That's what make it green. Now, when we looking at red candles, right? The red candle is going to open above and close down. So the red candle might very well go up to the high, go all the way down to the low, but close right over here. So, and that's how the green candle and the red candle. All right. We learned about long versus short. Long meaning the green candle, which is going up, short meaning the red candle going down. We also learned about the long shadows, which is right here, the line right here, that's the wick. All right. I know that this book also calls it the tail. And then we left off with candlestick patterns. So this is what we're going to be going over. Right, candlestick patterns are one of the most powerful trading concepts. They are simple, easy to identify, and very profitable setups. A research has confirmed that candlestick patterns have a high predictive value and can produce positive results. I personally trade candlestick patterns for more than 20 years. I can't really switch to another method because I tried thousands of strategies and trading methods with no results. I'm not going to introduce you to a holy grail. This trading system works, but be prepared to lose some trades. Losing is part of this game. If you are looking for a 100% winning system, I highly recommend you stop trading and go look for another business. Candlestick patterns are the language of the market. Imagine you are living in a foreign country and you don't speak the language. How could you live if you can't even say a word? It's tough, right? The same thing when it comes to trading. If you know how to read candlestick patterns the right way, you will be able to understand what these patterns tell you about the market dynamics and the trader's behavior. This skill will help you better enter and exit the market in the right time. In other words, hold on for a second. In other words, this will help you act differently in the market and make money following the smart guy's footprints. The candlestick pattern that I'm going to show you here are the most important patterns that you will find in the market. In this chapter, I'm going to show you how to trade them because this will be explained in detail in the next chapters. What I want you to do is focus on the anatomy of the pattern and the psychology behind its formation, because this will help you get the skill of identifying easily any pattern you find in the market and understand what it tells you to do next. If you can get this skill, you will be ready to understand and master the trading strategies and tactics that I'm going to teach you in the next chapters. Ania, I know you're on here. Can I make you host?
Yes, lady. Hello, everyone.
All right. I'll make you co-host so that when somebody comes in, you just let them in, okay?
Yes,
Thank you.
you're
Appreciate you.
welcome. You're welcome.
All right. So right now, we're going to talk about the engulfing bar candlestick pattern. The engulfing bar, as it states in its title, is formed when it's fully engulfs the previous candle. The engulfing bar can engulf more than one previous candle, but to be considered an engulfing bar, at least one candle must be fully consumed. The bearish engulfing is one of the most important candle patterns. This candle pattern consists of two bodies. The first body is smaller than the second one. In other words, the second body engulfs the previous one. See illustration below. This is how a bearish engulfing bar pattern looks like on your charts. This candlestick pattern gives us valuable information about bulls and bears in the market. Now, when we say bulls is the green candle where the market's going up. Bears is red candle when it's going down. So when you see the white candle would be the green candle, and the black candle would be the red candle. So this is a bearish engulfing bar. In case of a bearish engulfing bar, this pattern tells us that sellers are in control of the market. When this pattern occurs at the end of an uptrend, this indicates that buyers are engulfed by sellers, which signals a trend reversal. See example below. So here we go. We had the green candles, which in this book is white. We had a uptrend, right? And then we had the candle having a thinner body, but then the red candle engulfed that that green candle right there. So this is a bearish engulfing because the it engulfed the candle before it. So when you see this, right, you see that the green candle, which is the white one that we see here. Okay, I'm gonna have to put people on mute. Hold on. Hold on. All right. All right. So with this candle, right? Once you see that the body's getting small and then you see this big drop, this red candle, that's a bearish engulfing, and that can signal a downtrend. So over here, as you can see, when this price action pattern occurs in an uptrend, we can anticipate a trend reversal because buyers are not still in control of the market, and sellers are trying to push the market to go down. You can't trade any bearish candlestick pattern you find in your chart. You will need other technical tools to confirm your entries. All right. We will talk about this in detail in the next chapters. Right now, I just want you to open your charts and try to identify all bearish candlestick patterns that you find. The bullish engulfing bar pattern. The bullish engulfing bar pattern consists of two candlesticks. The first one is the small body, and the second one is the engulfing candle. All right, so right here we have the small body, which is the red candle. And then we have the engulfing body, which is the green candle. So remember, green candles open from the bottom, they close at the top. The bullish engulfing bar pattern tells us that the market is no longer under control of sellers and buyers will take control of the market. When a bullish engulfing candle forms in the context of an uptrend, it indicates a continuation signal. When a bullish engulfing candle forms at the end of a downtrend, the reversal is much more powerful as it represents a capitulation bottom. See the example below. Here we go. So we're in a downtrend right here. And then we see this bullish engulfing bar right here. So we got the first candle is red, and then we have the second candle is the green candle, which in this book, it's a white one. But if we were in the charts, the white one is a green one. So we see that it's going uptrend. So that means that it changed, it reversed. The example above shows us clearly how the market changes directions after the formation of a bullish engulfing bar. The smaller body that represents the selling power was covered by the second body that represents the buying power. The color of the bodies is not important. What's important is that the smaller one is totally engulfed by the second candlestick. Don't try to trade the market using this price action setup alone, because you will need other factors of confluence to decide whether the pattern is worth trading or not. I will talk about this in the next chapters. What I want you to do now is to get the skill of identifying bearish and bullish engulfing bars on your charts. This is the most important step for the moment. Doji. Doji is one of the most important Japanese candlestick patterns. When this candle forms, it tells us that the market opens and closes at the same price, which means that there is equality and indecision between buyers and sellers. There is no one in control of the market. So when you see this, we don't know who's winning here. At least if we see a big move like the engulfing bar, then you'll know who's winning the market. Right here, we don't know because it opened and closed at the very same price. As you can see, the opening price is at the same as the closing price. This signal means that the market didn't decide which direction it will take. When this pattern occurs in an uptrend or a downtrend, it indicates that the market is likely to reverse. See example below to learn more. Here we go. So right here we have an uptrend, and then we see a doji. Once we see a doji, then we see a downtrend. The chart above shows how the market changed direction after the formation of the doji candle. The market was trending up. That means that buyers were in control of the market. The formation of the doji candlestick indicates that buyers are unable to keep price higher and sellers push prices back to the opening price. This is a clear indication that a trend reversal is likely to happen. Remember, always, that a doji indicates equality and indecision in the market. You will often find it during periods of resting after big moves, higher or lower. When it is found at the bottom or at the top of a trend, it is considered as a sign that a prior trend is losing its strength. So if you are already riding that trend, it's time to take profits. It can also be used as an entry signal if it is combined with other technical analysis. The dragonfly doji pattern. The dragonfly doji is a bullish candlestick pattern, which is formed when the open high and the close are the same or about the same price. What characteristics the dragonfly doji is the long lower tail that shows the resistance of buyers and their attempt to push the market up. So here we go right here. We got the dragonfly doji, which means that the long tail is at the bottom. And the opening and closing price are at the top. The illustration above shows us a perfect dragonfly doji. The long lower tail suggests that the forces of supply and demand are nearing a balance, and the direction of the trend may be nearing a major turning point. See the example below that indicates a bullish reversal signal created by a dragonfly doji. Here we go. In the chart above, the market was testing the previous support level that caused a strong rejection from this area. The formation of the dragonfly doji with the long lower tail shows us that there is a high buying pressure in that area. If you can identify this candlestick pattern on your chart, it will help you visually see when support and demand are located. When it occurs in a downtrend, it is interpreted as a bullish reversal signal. But as I always say, you can't trade candlestick pattern alone. You will need other indicators and tools to determine high probability dragonfly doji signals in the market. So if we look at right here, we were in a downtrend, and then a dragonfly doji appeared, and we ended up going into an uptrend. And I was just about to show you that right here we have the opposite of a dragonfly doji. We have a gravestone right here where the arrow's pointing, which is what we will see right here. The gravestone doji. The gravestone doji is the bearish version of the dragonfly doji. It is formed when the open and close are the same or about the same price. What differentiates the gravestone doji from the dragonfly doji is the long upper tail. The formation of the long upper tail is an indication that the market is testing a powerful supply or resistance area. See the example below. Right here. The image above illustrates a perfect gravestone doji. This pattern indicates that while buyers were able to push prices well above the open, later in the day, sellers overwhelmed the market, pushing the price back down. This interpreted as a sign that bulls are losing their momentum and the market is ready for a reversal. So we had an uptrend, right? And we see the gravestone doji, but over here, we see kind of like a gravestone doji right over here. And then right over here, we see a doji. See, right over here, we see a doji right there. But then the next candle, we see right here, the white candle is the red, is the white, the green candle, I'm sorry. So once we see that gravestone, then we see a drop. Hold on for a second. Why is my screen acting up? Okay. So the chart above shows a gravestone doji at the top of an uptrend after a period of strong bullish activity. The formation of this candlestick pattern indicates that buyers are no longer in control of the market. For this pattern to be reliable, it must occur near a resistant level. So, and we are going to learn how to do support and resistance on your chart. As a trader, you will need additional information about the placement and context of the gravestone doji to interpret the signal effectively. This is what I will teach you in the next chapters. All right, so we got the morning star. The morning star, we got the bearish candle, which is red. And then we got another bearish candle right in the middle. And then we have a bullish candle. The morning star pattern is considered as a bullish reverse pattern. It often occurs in the bottom of a downtrend, and it consists of 3 candlesticks. The first candlestick is bearish, which indicates that sellers are still in charge of the market. The second candle is a small one, which represents that sellers are in control, but they don't push the market much lower, and the candle can be bullish or bearish. The third candle is a bullish candlestick that gapped up on the open and closed above the midpoint of the body of the first day. This candlestick holds a significant trend reversal signal. The Morningstar pattern shows us how buyers took control of the market from sellers. When this pattern occurs at the bottom of a downtrend near a support level, it is interpreted as a powerful trend reversal signal. So right here, this was a downtrending, and then we see a morning star, and then the market starts going up after that. The chart above helps us identify the morning star pattern and how it is significant when it is formed at the bottom of a downtrend. As you can see, the pattern occurred at an obvious bearish trend. The first candle confirmed the seller's domination, and the second one produces indecision in the market. The second candle could be a doji or any other candle. But here, the doji candle indicates that sellers are struggling to push the market lower. The third bullish candle indicates that the buyers took control from sellers and the market is likely to reverse. This is how professional traders analyze the market based on candlestick patterns, and this is how you will analyze financial markets if you can master the anatomy of candlestick patterns and the psychology behind their formation. The evening star. The evening star pattern is considered as a bearish reversal pattern that usually occurs at the top of an uptrend. The pattern consists of 3 candlesticks. The first candle is a bullish candle. The second candle is a small candlestick. It can be bullish or bearish, or it can be a doji or any other candlestick. The third candle is a large bearish candle. In general, the evening star pattern is the bearish version of the morning star pattern. See example below. So we see that the evening star is different than the morning star because we first had the big candle, which is the first one, and then we had the second candle that ended up being at the bottom instead of at the top. So that's what's different. Now that we have the evening star, the middle one is at the top. And then we have the bearish candle right there, the third one. All right. The first part of an evening star is a bullish candle. This means that bulls are still pushing the market higher. Right now, everything is going all right. The formation of the smaller body shows that buyers are still in control, but they are not as powerful as they were. The third bearish candle indicates that the buyer's domination is over. And a possible, hold on for a second. And a possible bearish trend reversal is likely to happen. See another chart that illustrates how the evening star could represent a significant trend reversal signal. Over here, so we have an uptrend, and then we have the evening star, right? And once we see that evening star, then we have it going down. All right. As you can see, the market was trending up. The first candle in the pattern indicates a long move up. The second one is a short candle indicating price consolidation and indecision. In other words, the trend that created the first long bullish candlestick is losing momentum. The final candlestick gapping lower than the previous candlestick, indicating a confirmation of the reversal and the beginning of a new trend down. And I think we're going to stop here. We're going to stop here. Next week, I'm going to show you in the charts all the patterns that we learned so far. So we're going to go to the charts. We're going to do a review next week and go to the charts. All right. So we just stopped. We did the evening star. We stopped at the morning star. All right. So next week we'll do the hammer, but I'm going to do a review and take this to the chart. All right. So I am going to go ahead and stop sharing. Hold on. And then I'm going to stop the recording. All right.